McCuistion. For over 25 years, talking about things that matter with people who care. Production of McCuistion is made possible in part by individual viewers, supporters of the Foundation for Responsible Television, CF Accountants and Consultants, adding value to clients throughout the region, the University of Texas at Dallas, creating the future.
This is part two of a two-part series on the causes of the 2008 financial crisis. Now, last week we looked specifically at the precipitous decline in underwriting standards that were caused by federal government policies which encouraged lenders to make loans that borrowers ultimately could not repay. We also discussed how Federal Reserve policy contributed. Today we'll look at some additional factors that contributed to the crisis, and remember that the reasons we need to review this issue are to get clear on what the causes really were so that we can assess what was done in the aftermath and what should be done to prevent another one. Let's meet the experts starting on my left. Rashad Abdel-Khaliq is the V.K. Zimmerman Professor of Accounting at the University of Illinois. He's a senior editor of the International Journal of Accounting, and he's published a book on risk and financial derivatives, and can actually explain how J.P. Morgan and Citibank helped Enron create fraudulent accounting. And Rashad, when you rolled that out last week at a conference I was in and running, everybody just said, my gosh, now we understand how this happened. So thank you very much for enlightening us.
Sure.
Sitting next to you is another accounting professor, and though Richard Bowen is a professor at the University of Texas at Dallas, he's best known as a Citigroup whistleblower who was fired for trying to get the attention of Citigroup's top management about the funding and resale of fraudulent mortgages. His testimony before the Financial Crisis Inquiry Commission and the SEC was largely ignored and even covered up to protect executives who are, in my estimation, too big to jail. Richard, welcome to the program.
Thank you, Dennis.
And now from that great state of Louisiana, C.R. Rusty Clouchet is the founding president and CEO of Mid-South Bank in Lafayette, Louisiana. And in 2009, he wrote this book, Big Bad Banks: How Greed and Ego Among the Big Shots in Banking and Government Created the Crisis That Wrecked Our Economy. But do you have a strong opinion about it, Rusty?
A little bit.
A little bit, I thought so. And last but not least, returning to our program is Michael Winston. And he's an award-winning executive. He's held top leadership positions at Motorola, Merrill Lynch, McDonnell Douglas, Lockheed, and Countrywide. But at Countrywide, he soon discovered massive fraud which he could not correct. His whistleblowing efforts led to a lawsuit which he won, sort of, but now we'll hear the rest of the story. So, Michael, let me start with you. We've obviously talked about these underwriting standards that went south because of government policy and the Fed, but in your estimation, what was another one of the big causes of this financial crisis?
Well, several. Thanks, Dennis. Number one, coming from the election, the preliminary election coverage, when you hear people like Hillary Clinton saying she's going to stop the shenanigans on Wall Street, and you hear President Obama saying a lot of recklessness occurred during those days, I want to give you my reaction. A shenanigan is me as a 7th grader hitting him, saying, "How are you doing?" And then all of his friends saying that I left him a kick me sign on the back. That's a shenanigan. Recklessness is kind of like an adult version of a shenanigan. But you know what? I saw nothing reckless from my perch at Countrywide. It was planned, organized, directed, and controlled. They did it strategically, they did it systemically, they embraced the loopholes that were either there or they created. What kind of loopholes? What kind of loophole would pay cash for foreclosures? What kind of loophole pays cash for terminating the most experienced fraud investigators instead of the least experienced fraud investigators? What kind of loophole allows a company to reward quality people and ask that they be brought in with the lowest amount of experience as opposed to the greatest? A company that embraces the loopholes. I want to just harken back very quickly to what's called the balance of consequences. Consequence. People do what they're rewarded for. That's called a reward system. People don't do what they're punished for. We learned this in Psych 101. Well, if you're rewarded for doing the right thing, then more right things happen. If you're punished for doing the wrong thing, that behavior is what psychologists call extinguished. But what happens if the incentive system rewards you for doing the wrong thing, and if it punishes you for doing the right thing? That's what happened, and it happened systemically. Regulators, appraisers, real estate sales, real estate financing. That is the broad brush with which we can paint all of these activities.
Okay, good. Thank you, Michael. Now, Rusty, you obviously have something in for the big banks. Your bank is, I think, about a $300 million bank these days. Is that about right?
$2 billion.
$2 billion. Okay, it was $300 million back in the day when you founded it. Is that right?
I founded it with zero. It was $300 million when I was involved with Fannie, Freddie, the SEC.
Okay,
and all
so that's
that.
where I got the $300 million.
Correct.
Okay, so now it's $2 billion.
Correct.
So are you in the whole place of too big to fail at $2 billion?
I wish I was. Look, what has happened? It's pretty simple. All roads lead back to 7 institutions. They're good at what they do. And by the way, Dennis, I want to compliment you on having this program, because there are not many people in the media would talk about this because of various reasons. But I'm very glad to hear that my cohort on the panel is going to talk about Enron and WorldCom. They pled guilty to that, $2 billion each. Goldman Sachs pled guilty about 3 weeks ago, $6 billion. I think it's approaching over $100 billion now they're paid in fines because they're too big to jail. They're too big to fail, too big to jail. When I wrote my book, I thought it would take 3 paragraphs to write Dodd-Frank. Little did I know the influence and the money that they had peddled all over that. That bill was written exactly the way they wanted it. As you can see today, they have grown exponentially. The small banks, the community banks in America, are declining at a very fast rate. So it's been to their benefit. It's been there. I don't care which bill you take. If you take Graham-Leach-Bliley, if you take Sarbanes-Oxley, you take Dodd-Frank, you go all the way back. Every bill is written by Wall Street, passed by Congress, and that's where you get greed and corruption, because it's to pay them off.
Interesting. So you're saying that it was Wall Street who wrote the Dodd-Frank Act? I thought they were up in arms about it. It's 2,319 pages, and Sarbanes-Oxley was only 66 pages, and Dodd-Frank was 2,319 pages. I don't think anybody read it. I'm fairly sure that Nancy Pelosi didn't read it because she didn't read the Obamacare Act.
Right.
But do you think that really Wall Street wanted that act?
Well, let me ask you this,